LiteFinance, the world of financial freedom.
Hello, it's Monday, March 6th, and it is time to start the market forecast. This week, compared to the previous one, is promising to be very exciting since we have a Powell testimony in front of the US Congress and NFPs which were postponed from the previous week. Later, of course, we will summarize the key fundamental factors to make a trading plan for EUR/USD. So as usual, let's begin with the calendar. On Monday, there is not much to talk about, so we move on to Tuesday, where the most important event will be the first day of the two of the Fed Chair Powell testimony about the monetary policy. So this will be one of the key events that most likely will shake the markets at least a little, but more on that in a moment. Next, we have Wednesday with the preliminary data about the Eurozone's GDP, second day of the Powell testimony, Bank of Canada interest rate decision, which shouldn't bring any changes to the policy, and very late Japanese GDP figures. On Thursday, only initial jobless claims from the US are worth watching, and on Friday we have the Bank of Japan rate decision, which also shouldn't bring any changes. After that, manufacturing production from the UK, and finally US non-farm payrolls. And that's basically about it in terms of the calendar. Now let's move on to the broader analysis of the most crucial fundamental aspects. So to determine where to invest money in the future EUR/USD rate, traders must understand what is happening with the US economy. But it is impossible to do now. A series of positive US macro statistics refuted the idea that the country is preparing for a recession due to the Fed's aggressive monetary restriction. If the situation remains the same, the question will arise whether all central banks should be closed. The biggest reversal in their monetary policy in decades does not affect the economy. So why is the economy growing again instead of the expected soft or hard landing? Is the good weather to blame, or were expectations too low? Is the economy unstable due to the recovery from the pandemic or the increased federal funds rate? So the situation is exacerbated by the contradictions between solid data, such as unemployment and retail sales, and soft data based on surveys. Solid data economic surprises were the biggest since the Fed began to tighten monetary policy. The situation concerning soft data is different. When the market does not understand what to do, it behaves inadequately. For a long time, US stock indices perceived good news from the economy as bad news for themselves. However, stronger than expected ISM manufacturing data helped the S&P 500 close in the green after 4 weeks in the red. Investors are beginning to realize that high rates will not destroy the economy. Why do we need a central bank if no matter how much the Fed cools the economy, it will continue to be hot? There is an opinion that the consequences of monetary restriction will begin to have an impact only at a certain rate level. Either the Fed has not reached it yet, or the time lag is too short for the economy to start to cool down. In any case, the Fed cannot risk raising borrowing costs in response to the strong data. In this case, Jerome Powell has to turn hawkish during his 2-day speech before the US Congress. However, the situation will be clarified not by the Fed chairman, but by the US February jobs report. Bloomberg experts predict an increase in employment by 215,000, but the previous estimate was exceeded by almost 3 times, which casts doubt on the new one, of course. Jerome Powell's speeches in Congress and the release of employment data, which investors have been looking forward to seeing for several weeks in a row, predict increased volatility of EUR/USD. There is a high probability of false breakouts of the consolidation range between 105.75 to 106.75. So, in such conditions, stay out of the market or change positions frequently, fixing insignificant profits. So guys, that will be all from my side for today. Thank you for watching and goodbye till next time.